basically like chapter 1 and chapter 2 are basically introduction on futures, forwards, derivatives. Okay, it is like mostly from chapter 4 we'll get into the real stuff. In fact, chapter 3 also will get into. So I'll try to cover chapter 1 and 2. That is positively will be completing. Chapter 3 will start and see how much we can finish today. Okay, so we'll start. Okay, so this chapter number 1 is from the book that we have for derivatives. We have to refer to the book Hull, okay, John C. Hull, Futures Forwards. Okay, this is like a very popular book in the derivatives world, and if you see, like, we'll be covering chapter 1 to except 8 and 9 will be covering from there. So the first one is the introduction about the futures market, and so let's see what the first aim says. The first aim says that you have to differentiate between an open outcry system and electronic trading. Okay, what is an open outcry system? Okay, so still now, like by the way, like many people think that open outcry system is not existing, but still now open outcry system is existing. Okay, in open outcry system, the traders meet physically on the exchange floor, so they are physically present and they trade in the floor. So what happens is that how the trading happens is through hand signaling, okay, through shouting. So one will say buy, another will say sell, and then they will these trades will match, and then they will trade. Okay, so here you have to be present on the exchange floor. So here physical presence is required. Okay, this is like used to happen earlier before the emergence of the electronic trading. Okay, so now what happens is electronic trading happens. In electronic trading, okay, you have to sit in front of computer and send the order, which will be matched with the orders that are there in the exchange. So the matching of, I would say, orders, not trades, matching of orders happen electronically. Okay, the traders need not be on the exchange floor. So if I want to trade on Chicago Mercantile Exchange, okay, I can sit here in India and I can send the order and I can trade over there. So it is not required that you have to be present in the exchange floor. Okay, so and most of the trading in the today's world is electronic trading. Open outcry system, there are only few products where open outcry trading happens, even in the Chicago Mercantile Exchange. Okay, so there are like trades like which are short duration. Okay, so which are like short duration, maybe like pork belly. Okay, so what happens is these are perishable commodities. So there typically the trading happens on the floor or using open outcry method. Otherwise, like most of the others are through exchange trading. Okay, now the next aim asks us to identify the difference between over-the-counter market and how it is different from the trading on the exchange. So what is the over-the-counter market? Okay, so if you see, we have been referring to OTC market and exchange. Okay, exchange is a place where like it's regulated. So it is a entity which is regulated, okay, by the regulator, by the government, I would say. Okay, so government will have some regulator and which will regulate this exchange. Okay, and when you are trading on the exchange, okay, you have to trade. So if A wants to buy from B, okay, so exchange will come in between A and B both. So this is not so you may not try to get the importance of exchange when you are trading in shares. Okay, because you will think, okay, OTC and exchange are roughly the same, but think about when you are trading in the futures market where the contract can be 10 years long also. Okay, so in that case what happens is if you trade with this guy directly, there are risks that this person will get defaulted. So that is exactly what happens in the OTC market. A trades with B directly without a presence of any third party like exchange. Okay, when exchange is present, you have a third party. What happens is exchange will take the risk. So what happens is exchange has a body called as clearing house. Okay, so exchange has an entity clearing house which does the clearing, and also it is an entity which takes the risk. So think about a case wherein B, okay, B had to pay to A some $10,000, okay, and by some act, let's say B defaults, okay, so exchange will give A $10,000. So the risk is on the exchange or the clearing house. So clearing house takes the risk. Okay, clearing house typically provides membership. So there are some people known as clearing house members. Okay, so note that you would have heard the name of broker. Okay, so if A want to trade, A will trade through his broker. Okay, so A will trade to his broker. Broker will send the trade to exchange. Okay, but for clearing purpose, broker will contact a clearing house member. Okay, and this clearing house member will go to in turn turn to clearing house. Okay, so the way it happens is, okay, to we will see in details, but this A has to provide some margin, okay, or some collateral. So A will provide some collateral to trade in the futures market. So A will provide some money to the broker. Broker will deposit that money to the clearing house, and the clearing house member will deposit to the clearing house. Okay, so this collateral is a kind of a security. So it is a security that this A will not run away in case A has to give some money to B. So we'll see that how exchange keep track of that. So but what happens is, because of exchange, what happens is you have a regulated entity, okay, and exchange takes the risk. Okay, but because of its regulation, like exchange may not provide you to buy anything, okay, or trade anything. So exchange will provide a set of contract. So exchange will provide a set of contract which you can buy, okay, or you can sell. So there is a set of contract available for trading purpose. Okay, you cannot buy anything. So that is the disadvantage of exchange. So let's turn to OTC market. Okay, in OTC market, whatever kind of contract you want to make with B. Okay, so you can say that, okay, I want a contract which is made up of TCS stock plus Infosys stock plus Wipro stock. Okay, and you can get that. Okay, only thing what you have to make in sure is B is agreeing with that. So let's see what are the advantages. So over the counter market, it's a private contract. Trade happens between two counterparties over phone or through computer system. Okay, now what are the advantages? The advantages is like you can have non-standard term. Okay, so like in exchange, like let's say in US, what they say is it should happen, the expiry should happen on third Wednesday of every month. In India, it is last Thursday of every month. Okay, let's say last Thursday falls on to, let's say 24th of March, assuming. Okay, but you do not want to expire on 24th March. You may want to expire on 31st of March. So that you will not be able to get on the exchange. You have to only get into the OTC market for that. So you can have non-standard term like expiration can happen on any particular date as determined by the two parties. Okay, also it's not strict, as you have the parties which are available, which are trading in the OTC market among themselves. These are big parties. We too cannot trade in the OTC market. Okay, so there are like big counterparties which trade, and what happens is these two parties are financially sophisticated. Okay, so since they are financially sophisticated, the advantages of over the counter market. Okay, now mark to market. Okay, we'll deal it shortly. What exactly is mark to market? Okay, now what are the disadvantages? Okay, the disadvantage is, what if B goes bankrupt and A has to get, let's say suppose $10,000 from B. If B goes bankrupt, A will not get that money. So that is a risk on A. So there's a default risk on A. So that is a counterparty risk. So it's a type of credit risk that the counterparty faces. Okay. What happens is, like earlier, like OTC markets were not regulated that much, but after the like recent crisis, okay, so there is like a buzz, like they are trying to come up with lots of restrictions on the OTC markets. Also they are trying to make them somewhat accountable. It is not like entirely they want to regulate, but they are making some of these things accountable. Okay, so they are like trying to come up with a trading of some credit derivatives product on the exchange. So this has already started trading, and for plain vanilla trade it is doing pretty well. Okay, so let's see some of the concepts. Okay, some of the definition which will be useful. Now what is derivative? Okay, so we have been talking about these derivatives, but we have to first understand what is derivative. So derivative is a financial instrument, okay, which does not have a value of its own. Okay, so it derives value from some other value. So let's say if you want to purchase, let's say you want to purchase oil. in 1 year. Okay, so you want to purchase oil in 1 year, but you want to enter into a contract now only. So you want to enter into a contract now wherein you will be able to purchase oil after 1 year. Okay, so this is a contract that you are entering. So this is a derivative contract. So this gives you a right to buy the oil in 1 year at a certain price, let's say $125. Okay, so whatever the price, it doesn't matter to you, you will purchase at $125. Okay, so the obviously this you are buying, so this price or the value of this contract on oil will depend on the value of oil. Okay, so the underlying can be anything, stock, index, commodity, weather. Okay, so these can be like the underlying can be there. Okay, now there are in exchange you will find that there are some traders who are named as market makers. Okay, what are market makers? Market makers are those guys who provide liquidity. Okay, so what is liquidity? So before that, like if we want to know what is liquidity, we have to understand the structure of the market and how trading happens in the market. In market you have a concept of bid and ask. Bid is known as buy, ask is known as sell. So S for sell, B for buy. Okay, this ask is also known as offer. Okay, let's say I want to buy. Okay, so let's say I am sending an order on the exchange. Okay, I want to buy 10 shares of Microsoft. Okay, at a price of, let's say, $25. So I'll send the order 10 shares of Microsoft at a price of $25. So what I will do is I will say 10 shares I will put, and in the exchange it will come like this, 10 at 25. So this is the quantity, this is the price. So what happens is in the exchange you will be able to see bid, ask, quantity, price. Okay, many times this is the price and this is the quantity, just to make sure like you are able to see this guys matching. Okay, but doesn't matter, we can see that 10. So this is the, you have placed an order to buy, so you are placing a buy order, so it will go over here as buy order, 10 at 25. Okay, let's say there is another person who is interested in selling 20 shares of Microsoft. Okay, but he wants to sell at $26. So what he will do is he will place 20 shares at $26. Okay, so this is how it will come. So I have just given it down. I will change it. Okay, so this is saying sell 20 shares at $26. So the moment you say sell, okay, so here it will come. This bid ask concept, it is known as order book. Okay, so it is a order book, it is a collection of all the orders that are being sent. Okay, now we have concept of these orders which we are sending. This, since I am specifying the price, okay, this order is known as limit order. So this is known as limit order. So you are specifying a price, you are saying it's a limit order. Okay, so you are specifying buy, that's why it is coming on the buy side. You are specifying over here sell, so it is coming on the sell side. Now what happens is, okay, let's say suppose there's one more person, he wants to buy 10 shares. Okay, but he wants to buy, and he is saying that he will buy only at a price of 24. He want to buy at 24. Okay, so where it will come? 10 at 24. So it should come on the buy side. But the question is, should it be coming before this or should it be coming after this? So on what basis the order of the hierarchy is defined? Okay, so the hierarchy is defined on the basis of price, okay, and time. Okay, a time at which you are sending the order. First priority is given on price. Okay, on the bid side, okay, on the bid side we have the highest or lowest. Any idea? On the bid side, if this 24 is coming, so first we are seeing on the price. Okay, so this 24, 10 at 24 will come here or will it come here? So what happens is, how the trading happens is that you are, so think about, you are going to market, okay, and you are saying that I want to buy something. Okay, this guy is saying that he want to buy at 25. This guy is saying he want to buy at 24. Whom the shopkeeper will sell first? To him or to him? Naturally the shopkeeper will sell to him first, right? So what happens is, this guy will take the priority, this guy will be given a lower priority. So 10 at 24 will come over here. Okay. So when you in the bid side, what we have is highest price first. Okay. But when the price matches, okay, then the order which came first will be given the higher priority. Okay. In reality, what they do is the exchange they have like so they have like 925, then 30-second, then they have millisecond, they can have till microsecond. So like to a very granular level they decide. But even let's say if all of these things are matching, if they both are matching, then that's a conflict. Otherwise, we have lower time will come first. If the price is same, lower time will come first. Okay, so they can go up till like a very low level of detail. So typically that low level it doesn't happen much. Okay, so that is a case. Let's say you want to sell, somebody wants to sell 2 shares at a price of 25.5. Okay, 2 shares at a price of 25.5 sell, where it will go, here or here. So he's trying to sell, it will come over here, and he's trying to sell at 25.5. So will it come above this or below this? So what happens is, please note that, think of again same. So there are like 10 sellers in the market. Okay. So one first seller is selling at 26, another is selling at 25.5, another is selling at 27. Whom will you approach first? Whom will you go to? You will go to that seller who is quoting the lowest price. So here you will have lowest price is the priority. So you will give lowest price priority. So here you will say 2 shares at 25.5 will come earlier. Getting this idea? So what I will say is 25.5, the lower one will come over here. But again, think about it, what is happening. A buyer is willing to buy at 25, but the seller is willing to sell at 25.5. Okay, so that means when you are going to market, like you will not be able to trade. Why? You want to buy at 25, you want to sell at 25.5. So we say that top, it is called as the best bid. Okay, best bid is the highest bid price, highest price. This is called as best ask, the lowest price possible. Okay, but please note that this best bid and best ask, there is no trading happening. Okay, the difference minus 25, the difference is 0.5. This difference of 0.5 is called as bid ask spread. So this difference is known as bid ask spread. Okay, now what we say is, the higher this bid ask spread is, the bad it is. Okay, so we want to have this bid ask spread as low as possible. Okay, if it is very low, it is good, because what happens is, that means the trading will happen more, because there is no difference between the traders. Okay, so what happens is, this bid ask spread is sometimes thought of as liquidity. Okay, so the lower the bid ask spread is better. Okay, now here there is no trading happening, right? So what will happen is, the exchange has employed people like market makers. The exchange have employed people like market makers. So what market makers does is, it takes the opposite position. Okay, so what is happening, this guy wants to sell at 25. Okay, oh sorry, want to buy at 25, but nobody is willing to sell at 25. Okay, so what the market maker will do is, okay, whenever he sees, okay, there is somebody who want to buy at 25, so he will put a quote. Okay, sell, he wants to buy 10 shares. Okay, maybe he will say, okay, I will sell 5 shares. Okay, so he will say 5 shares, sell 5 at 25. What will happen is, the moment he is putting this 5 at 25, where it will go, above or below? It will go above. 5 at 25. Now this 25 and this 25 is matching. So there is a match which is happening, and what will happen is, the moment this matches, okay, this is removed from the exchange. So this order has matched with this. So order has become what is known as trade. Okay, so whenever there is a match happens, okay, match will happen only when the prices will be equal. So here 25, here 25. So that order will become trade, and this 10 will become how much? So from 10, 5 has already matched, so it will remain as 5. Okay, So in your bid, it will now become 5 at 25. Okay. So this market maker has tried to give him opportunity to buy. Okay. He could have done entire 10 also. Okay. Market maker can take position like this also, wherein what he will do is he can buy. He can buy at 2 shares at 25.5. Okay. So just to ensure that this guy is able to sell. Okay. But think about what is happening to the market maker. He is selling at 25, he is buying at 25.5. Doesn't he make loss? So in this case, you may think he is making loss, but that is the work of market maker. The work of market maker is to provide liquidity, and they are paid by exchange to provide liquidity. But please note that rarely any market maker makes losses. The reason is because the market maker knows what all orders are there. So this bid ask, which we are seeing only 2 3, okay, so if there are 10,000 bid ask orders, okay, he will be able to see all this. So market makers are in a position to understand the movement of the market. So if they see lot of orders on the bid side, okay, so they will think that market will move up because there are more buyers. So when there are more buyers, there will be more orders. Okay, there are more buyers than sellers, the price will move up. So they will take a position such that like they will try to buy this and later sell at a higher position. So the market maker tried to earn on this bid ask spread and also on the movement, but their primary motive is to ensure that liquidity is there in the market. So they may not want to sell, like they may not want to put this 5 sell at 25. They rather than that they can put it 5 at 25.1. Okay, so their work has become they have reduced the bid ask spread. Okay, so seeing these many people will come. So this they might want to 5 at 25.1. Okay, whereas like other people will see okay 25.1, they maybe they will sell at 25.05. So their purpose is being met. That is, they are trying to increase the liquidity. Increasing the liquidity is one of the measure is we are saying that the decrease in the bid ask spread is increasing of the liquidity. Okay, so this is how the order book will work. Okay, so as per the efficient market hypothesis, we said that there are people like who are able to earn above the market. Market maker are those kind of people because they have inside information. In reality, like if you see, if you go to NSE, you have only 5 bid ask spread is shown to you. In CME, depending on the products, they may show you 5, they may show you 10, they may show you 2 also. But market makers, they have access to the entire list. I will not say that they create more speculation. They are kind of like taking the risk. Please note that it's not that they are not taking the risk, but what they are trying to do is they are trying to say that okay, you want to buy, I will make sure that you get the shares to buy. Yeah. And if you want to sell, I will ensure that you have some person to whom you can rely on and you can sell your shares. So they are trying to ensure that in the market people are there who are becoming a buyer and seller uh, of your stocks. So the idea is to provide liquidity. This is the simplest idea, because what happens is if let's say there is no liquidity in Microsoft stock, okay, what will happen is like people will not trade, and unnecessarily like the company will also be not able to make a lot of money by issuing new shares. So liquidity, so there is a measure of liquidity risk. So liquidity risk will be higher in this stock. As a result, the required rate of return will be higher. Okay, so what we have is, okay, so we have covered bid, ask, bid offer, spread, okay, market makers, okay, derivatives, okay. What is a spot contract? So we have like seen futures, okay, futures are like something you are buying in the future at a later date, whereas spot contract you want to buy it now, okay. So you have a spot gold and you have gold for futures. So when you want to buy gold for today's consumption, you'll say gold spot. Okay, when you want to buy future gold in future after 1 year, so that is a futures, so that is not a spot. Okay, whereas a long, what who is a long, we'll say that buy means long. Okay, the person who is taking who is buying the contract, who is buying the product, he is long, and the person who is selling the contract, he is short. So long position, short position. Okay, now what are the different type of players who are there in the market? There are like three type of players we say. Okay, hedgers. Hedgers are those participants who want to protect themselves against losses. So they want to like hedge their position. So neither so they want to enter into derivatives contracts such that there will be no effect on their position in the future. Okay, so this is what hedgers say that. Okay, please note that spot is always cash settled. Okay, always. So you pay cash, you take the amount, you take the cash settlements, you pay the cash and you take the product. Okay, so I would say that there's no concept of settlement, cash settlement over here. Okay, cash settlement usually is being used for derivatives where the difference is paid in cash. So cash settlement here is you pay and you take the stuff. So the appropriate word will not be cash settlement. Okay, hedgers, they are participants who want to enter into the derivatives. They want to protect themselves. Okay, and after this there will not be any change. Whereas speculators are those kind of people who want to make money. So let's say, suppose like I speculate that Nifty will move up. Okay, so I will buy Nifty. Okay, I speculate that let's say gold will move up, I will buy gold. Okay, I speculate let's say oil will move up, I will buy gold. But let's say there's a let's say Reliance. Okay, Reliance is importing oil and filtering refining it, and if Reliance buy the futures contract on oil, they may want to hedge themselves. So they may want to buy some oil at a future date. Okay, and they want to hedge themselves against a increase in the oil price. So here they are acting as a hedgers. Okay, so please note that in market, all the people, if they become hedgers, there will be no market. Okay, in the market you need to have people who will try to make advantage of the situation, who have some expectation, and these speculators are required. Then there are people who are arbitragers. Okay, arbitragers are those people who will try to earn the difference by maybe trading the same product in different exchanges. Okay, or they may want to buy future, sell the spot. They may want to buy spot, sell the future. So they will involve into both buying and selling. Okay, such that they are earning a small difference. Okay, that small difference may not be like too much for us, but think from a perspective of an investment bank which who are dealing with millions and billions of dollars. Even if they are getting a very small fraction as arbitrage profit, it may turn out to be huge. And please note that arbitrage profit is what these arbitragers generate. Okay, and please note that many places theoretically we say that arbitrage is a activity which does not entail risk, but there is no such thing like which is risk free arbitrage. Some or the other risk you will be taking. Okay, so there is some other risk that you will be taking. Even so, LTCM, they were doing convertible arbitrage, but they still failed because there is some risk which they had ignored. Okay, so these are some of the definition, and there are some other definition which is there in the next chapter. Let's try to cover it now only. Okay, so that we are if there are more number of trades happening in the market, okay, the bid ask spread will be lower. So if you see high volume, okay, high volume typically will be having lower bid ask spread. Okay, so let's try to understand some of the other concept. Okay, this is related to orders. Okay, orders are also important. So there are like some orders known as market order, limit order, stop loss order, stop limit. So we'll try to understand what are these orders. So again, understanding of the bid ask is very important to understand this. So you have bid, ask, sell or offer. This is buy. So buy is equal to bid. Okay, typically you have quantity, price. Let's say quantity, price. Okay, now we have said that when you put a buy order, when you put buy 10 shares at $25, When you are putting buy 10 shares at $25, when you are specifying the price, you are specifying an order which is known as limit order. Okay, so you are specifying that I want to buy at $25. Okay, so that order is a limit order. Okay, so let's say the current situation before your order is coming, the current situation is this: 100 shares somebody is willing to buy at 25.5. Okay, there is somebody who is willing to sell 20 shares at 26, and then there is somebody who is willing to sell 15 shares at 26.2. There's somebody who is willing to buy some share, let's say at 25.3, 10 shares. Okay. The moment you send this, it will come over here 10 at 25. So this is your order book. Okay, so when you put this here, your order book looks like this. Okay, now many times what happens is, like, let's say you have put this 10 shares at 25. Okay, you are third in the queue. First this will get executed, then this will get executed. Okay, now if you see there are 110 shares. Okay, there are only 35. So if you see the total volume, it is 35. Here the total buy is 120. So you may think, okay, it will take a lot of time for your order to get executed, because 25.5 will be first filled and then your turn will come. Okay, so in that time what you may want to do is, okay, you may want to become slightly aggressive. Okay, how you will become aggressive? You will say that, okay, I will want to buy. Okay, you will say I will want to buy, but these 10 shares I want to buy at market price. Okay, now what is this market price mean? What exactly this market price mean? Okay, so when you are saying that you want to buy at market, okay, your order will not go like this. Okay, your order will become 10. Okay, and it will come at the top. Okay, and it will show market. Okay, when it shows market, what happens is, whenever this is the market, this is the top, it will match with the best available. So here the best available is this, so it will match with this. Okay, so what we say is, when you are trying to buy at market, you will buy at best ask. Okay, when you want to sell something at market, let's say you want to sell 10 shares at market, it will come as sell at best bid. Please note that I have tried to show over here 10 at market. In reality, it does not happen. It will not go. It will go to the order book immediately. This matching will happen, and what will happen is 10 shares at market, it will get traded. Okay, it will become 10. Okay, so what will happen is, and then you will say, whenever you put buy 10 at market, okay, after that it will say executed. Okay, and latest trading price will be what? What will be the latest trading price? Latest trading price is the price at which it is executed, so it will become 26. Okay, so this is how it will happen. Okay, when you are selling 10 at market, what will happen? So your order will go over here 10 at market, it will match with the best bid. Okay, so this will match, this will go, this will match with this, 90 will come, and your latest trading price will become 25.5. Okay, so there is a concept of technical analysis. Okay, in technical analysis, what we say, okay, is that stock has what is known as support level and resistance level. Okay, so if you see the price, so this is time and this is the stock price. Okay, so what will happen is, okay, so the stock price, what we say is, it is bonded between the resistance. Let's say resistance level is 120, the support level is 80. So the stock price will move like this. Okay, so it will be difficult for the stock to break this level. It will difficult for the stock to break this level. Okay, because what happens is, if the stock price come near 80, people who were thinking that the stock price is attractive, they will start buying over here, and people who think that the stock price is expensive over here, they will start selling. So stock price will decrease, here it will increase. Okay, but what happens is, it is very much possible for a stock to go like this. So what it says is, once the stock price breaches the support level, okay, the stock price will decrease very much. Okay, another line of thinking is, if the stock prices breaches the resistance level, it will increase a lot. Okay, So what we have is, in the market there are people who are short seller and there are people who are buyer. Okay, so let's say you have bought a stock somewhere around here at, let's say, price of 85. Okay, you are concerned that the stock price may become less than 80. Okay, and if it becomes less than 80, you are predicting that the stock price will come to 60. Okay, so what you say to the exchange is that I want to sell my share. Okay, so you have already bought, you want to sell your share the moment the stock price reaches which level? 80 level. So it says that the stock price, it reaches 80 level, you will want to sell your share. So this 80 level is called as stop loss level. Okay, so it is called as stop loss level. Here what happens is, the moment it become 80, so the exchange will place a order, sell at market. Okay, so these orders are known as stop loss orders. Okay, so what is stop loss orders? Stop loss orders are those orders in which you specify to the exchange that you want to sell your shares the moment a level is hit. Okay, here my level was 80. Okay, so this is, and since you are saying that, so you are saying that here 80 you want to sell, and below it can go anything, you want to sell there your shares now. Okay, and for a, so this is when you have already bought the shares, you will put this order. Okay, yes, so this, when you are selling at market, it may happen is, depending on the liquidity, it can execute at 75, it can execute at 70, it can execute at 60, whatever the price, you will only come to know after the trade has happened, not before. So it's very, very risky to give a stop loss orders. Okay, because it can execute anytime. So exchange know that difficulty. So what they have done is, they have combined a stop loss order and a limit order. So they are calling as stop to limit order. Okay, so you specify that, you are putting a stop loss order. You are saying that you are putting a stop loss order, and what you will say is, this stop loss order is put, but you are saying that there is a limit to which you can go. So there is a limit to which you can go, and that limit is what you decide. So you say that, okay, I do not want, so you say that stop loss level. So there is a concept of trigger level. So there is a stop loss trigger level. So this trigger level was your 80, was your trigger level. Okay, so your trigger level was 80. You specify the trigger level is 80, but limit is, you say 75. I do not want to go below 75. Okay, so that is your stop to limit order. Does it make sense? Okay, so you have a order which is stop loss order, you have a stop loss plus limit order, stop to limit. So in this case, stop loss orders, you are selling at market and you can get fills at extreme level. So at extreme level you could get, so you are putting it 80, and if they, let's say the bid, so let me give an example. So let's say you have bid, okay, and ask over here. So you had earlier bought the shares, 10 shares you had bought at 100, let's say 100 rupees, and you had put a stop loss, the trigger price you had put as 80. Okay, and this is what you had done. And what happened is, let's say how this trigger will happen. Okay, let's say there are 10 shares at a price of 81 to be traded, and there's a, then there can be other orders, and then there is an order 10 at 82, then there is 10 at 85. Okay, then there can be 85. It should be more or it should be less. This will be increasing or this will be decreasing. And let's say 20 at, will it be 70? Can it be 80 over here? Okay, so this is the kind of structure you will have. So what happens is, this trigger price will, so think about, there's a person who, so let's say this is 78 and this is 80. So somebody comes and say that, okay, he want to sell 10 shares at market. What will happen? These two will match. What is the latest trading price? So when somebody puts an order 10 at market, these two will match. So the latest trading price will be 80 rupees, right? So this 80 rupees is matching with the trigger. So what will happen is your stop loss order will get triggered. Okay, let's say you wanted to sell 110 shares at price, and so you bought 110 shares. So when you bought 110 shares at the trigger, you will be selling 110 shares. So you'll be selling 110 shares. Let's say this is 20 at 78, another 20 at 70, is another 20 at 65, there's another, let's say 20 at 62, there's another 20 at 60, there's 10 shares at 50. Okay, so this is how the moment this 10 shares at market will go, this will match. Okay, so this will go. So what we are saying is there's 110 shares at market price. Okay, you want to sell because this got triggered. Okay, so this will be the order that will come to the exchange, and this 110, what will it will happen is first 20 will go. The price that you will get is 78 for the first 20. Okay, 90 will be left. Okay, then again 20 will go. Again after that 70 will be left. 20 will go at a price of 70. So see the impact that you are having. 65, then 20 will go. 62, like that way happening. So what is happening is you had put 110 shares at market. You thought that you'll be able to get roughly price around 80, but because of lack of liquidity, your price is decreasing. So you started at 78, you will end at 2, 3, 4, 5, 6. So last you will get at 50. So the average price would be very low, maybe around 60, 65. It will be the average price will be that you will be getting. Okay, so that is the problem with your stop loss order. Okay, because stop loss order by definition it will become market. So the exchanges, what they are providing is they are providing stop to limit order. So if in this case you had provided a stop to limit order, but you had said the trigger price was 80 and stop to limit order, and the limit you had specified, let's say at 75, okay, or let's say at 70. So you will not be trading at these levels, because what it will do is it will trade 20, it will trade this 20, it will say that 70 has reached, next is 65, it will say no, it is beyond my limit, I will not trade. Okay, so this is your stop to limit order. So you have market order, limit order, stop loss order, then you have stop limit, combination of stop and limit. Okay, so as soon as stop is breached, your limit order will be sent. Okay, then you have some orders like market if touched. Okay, so many times see stop loss orders was to protect you. Stop loss order was to protect. Now this was to protect you. Okay, suppose you want to uh, gain. Okay, so think about, let's say you have bought a stock at 80 rupees. Okay, 80 rupees you bought. Okay, and you want to sell it the moment it, so we had seen this, right? Support was at 80 and resistance was at 120. Okay, so you had bought at 80. Now you know that okay, if it the moment it becomes around 120, the high chances are that it will fall. So you say that okay, if the stock price reaches 115, you want to sell. Okay, so you want to sell if the stock price reaches 115. So what you can do is you can put the order like that, that sell if stock touches 115. Okay, please note that this is not a stop loss order. In a stop loss order, what happens was the trigger price was below the current price. So the price was here. This was no, this is not fill or kill. I will tell you what is fill or kill. So in the stop loss order, the price was over here. The trigger price was set below. In this case, the trigger price is set above. Okay, you want to take a profit. So here you want to take a profit of 35 rupees around, or so it will be sell at market, by the way. Okay, but you want to take a profit over here. Okay, here you are trying to protect against your losses. Okay, so that is what it says, that sell if touched. Okay, so this is like market, this is order if touched. So you have market if touched, so it will become market order if the trigger price is touched. So best available price after at a specified price or a better price. Okay, now there are some orders which are discretionary orders. Okay, The discretionary orders are like, let's say I send an order to my broker. Okay, I say it's a market order. Okay, but I say that the decision to send this order to the exchange is on the broker. Okay, if broker thinks that the market environment is suitable, he can send my order. Okay, if he thinks that the market is not suitable, he will not. So I am giving a discretion to the broker. So that is why it is called as discretionary order, where we are saying that you can delay my order till you think that it is suitable. Okay. Then some orders are time of the day. So you can say that your order will get specified at a particular period of time. Okay, so time of day. So you can specify that it will get traded only between this and this time period. Okay. Open orders are those orders which are not being traded. Okay, so they are not being traded and they are still live. So they are live orders. Okay, and typically what happens is, by default in markets you have a concept of good till day. Okay, good till day order are also called as day order. So the orders will be there, will be open till the end of the day. Till the end of the day. After that, if it is no execution is done, they are expired. They get eliminated. Okay, this is normally what happens is, but what you can do is you can specify some orders which are like what is known as GTD order. Okay, rather than good till day, it is, any idea? It is good till date. Okay, so let's say you are putting a order on 28th of February. Okay, you will say that this order 10 shares, buying by 10 shares of Microsoft at $20, and you are saying that GTD till 20th of March. So this will be there on the exchange till 20th of March. Okay, if it is filled, then it will get eliminated, but if it is not filled, it will get eliminated only on 20th of March. Okay, otherwise the day order gets are open till the end. If they are not traded at the end, they are flushed off from the system. Getting it? Okay, so these are like a good till date are like in effect until executed. Okay, or you can also say that you can have some orders which will be open until it executed or end of the trading or at the expiry of the futures contract. So you can say that you can have some orders which are open. Okay, you will say that open orders till expiry. So you say, let's say you want to buy 10 shares of Microsoft futures at $20. Okay, and this is a Microsoft future expiring on, let's say, 25th of March. Okay, you will say that this will be open till executed or the contract is expired. Let's try to understand the concept of immediate or cancel. In India, it is known as immediate or cancel. It is known as FOK. Okay, so fill or kill. So let's say many times what happens is, I want to buy 50 shares, maybe whatever the reason, I want to buy 50 shares. Okay, at a particular price. Okay, if I am able to get that at that price, entire 50, then I will be happy. I will say okay. If I am not able to get that, I will say that entire order should be cancelled. So think about this case. Okay, you have bid, you have ask. Okay, in the bid you have 100 shares. Okay, which are trading, which they want to buy at 25. Here ask has 1000 share at a price of 26. Okay, now let's say you are putting, you want to sell 50 shares. Okay, at a price of 25. Where your order will come? Can I say your order will come over here above this 50 shares at 25? It will match with this and your order, and you are specifying that this is FOK order. You are specifying that this is FOK order. You want to sell 50 shares FOK order at 25. Okay. Now what will happen is it will match with this. Okay, so 100 at 25, 50 at 25, it will match. Okay, and this will become 50. Okay, this was matching, your entire 50 was being filled. So here your entire 50 is being filled, so it was okay. Okay, but think about a situation where bid ask is like this. you have only 10 shares at 25, you are putting a price 50 shares you want to sell at 25, okay, and you have 1000 shares at 26. Okay, here what is happening is you want to sell 50. How much will match? Only 10 will match, right? So you have said FOK order, you said that fill full or none. FOK order means that either you want full or none. So here only 10 are available. So what will happen? So either fill full or none. So none will happen. So what will happen is your order will get cancelled because you are not getting this. So entire thing is not matching. So if all is available, then only it will get filled. If less than that is available, it will be cancelled. So cancelled means it will be out of the order book. Okay. Now there is a slight different type of orders, and they are called as FAK order. What is FAK order? Fill and kill. Okay. So if instead of this 50 being FOK, if it was FAK, and it was a FAK order and you were sending 50 at 25, right? So FAK order, it was sending at 50 at 25. It was seeing 10 at 25. What it will do is you are getting 10. So it will say, okay, match 10. Okay, at least I am getting 10 and cancel the remaining 40. Getting this? So it will match 10 and it will cancel the other 40. So that is what FAK order means. FAK order is fill and kill. FOK is order is full or fill or kill. So FOK means either full or none. FAK means whatever. It can be full or it can be partial also. So partial is allowed. Correct? Can I say this? The stop limit is not same as short selling. Okay, a stop limit order is when you already have IOC is equal to FOK. Yeah. Okay. Please note that early stop order is not equal to short sell. Okay. Short sell orders are those orders which you are selling something without the ownership. Let's say if I do not have ownership of Reliance share and I sell them. If I do not have Reliance share, I sell them. What I am saying is I am short selling them. Okay. Stop orders are to protect. Stop order can be applicable for short sell also. Okay, it can be applicable for short sell also. Let's say I have sold the Reliance share at 800 rupees. Okay, and Reliance share has a potential to move above 900. So what I will do is I will put a stop loss order at 850. So the moment it reaches 850, I will buy it back. Okay, so this is what I will do. Okay, so here what I am doing is I am putting a stop loss buy order. Okay, so what you can have is a stop loss order can be two type. Okay, it can be stop loss buy order or stop loss sell order. Okay, a stop loss buy order is applicable if you have earlier done some short sell. A stop loss sell order is done if you have earlier done buy. Okay, so think about is this stop loss order has to be exactly opposite. So it should be exactly opposite of your earlier transaction. If you had earlier bought, you will now sell. If you have earlier sold, you will now buy. That is your stop loss, because you are protecting yourself against the losses. So you will take the opposite action. Okay. So these are your order types. Okay, so this just I wanted to cover earlier because you might be like interested in knowing all these things. Okay. Please note that best bid and best ask are the sitting orders. Okay, FOK and FAK order are the new orders. Okay, your sitting orders cannot be FOK or FAK because they're either fill or kill. Immediately it gets filled or it gets cancelled. So there cannot be any sitting order which is FOK or FAK. Okay, because the intention is to fill or kill, right? So it will immediately get killed if it is not there, if it is not killed, not filled. Differentiate between options, forwards and futures contracts. So please note that we have seen this earlier, but option contracts have contingent claims. Okay, only trading in OTC market. Futures only trade in exchange. So futures only, so they can be traded on both exchange. So there are two type of options. Okay, one option is called as, so there are like we have like a distinction. Okay, so let's try to understand the distinction. Okay, that is better. Okay, option gives the buyer the right. So here what we say is people get confused between the buyer. So I will say that this buyer is the option buyer. Option gives the option buyer the right to buy the underlying asset at a fixed price. So the option buyer, this fixed price, it is also known as strike price. So fixed price is known as strike price for the option. Okay, the right to buy the underlying at a fixed price. Okay, so here what we say is, okay, think about, let's say you want to buy option on Reliance, okay, and you want to buy Reliance share in the future after 6 months. You want to buy Reliance share at, let's say, 850 rupees. Okay, so what you will do is you will buy a option which is known as call option. Okay, so options, okay, the buyer the right to buy the underlying at a fixed price, it is known as call option. Okay, there are two type of option. One is call option and another is put option. So what the call option does is, call option provides the buyer the right to buy the underlying asset at a fixed price. So if you want to buy Reliance share at a price of 850 after 6 months, you will have to buy the call option having a strike price of 850. Okay, but since you are having the right, you will have to pay something known as premium. So you will say that, okay, for getting this right, you want to give 20 rupees today. So you will have to pay a premium of 20 rupees today. Okay, so let's say after 6 months, the price of the option, the price of the Reliance share, the price of the Reliance share becomes 900. So the price of the Reliance share becomes 900. Will you exercise your right to buy at 850? Will you exercise your right? So what we say is, option buyer, the call option buyer has the right to buy the underlying asset at a fixed price. This fixed price is called a strike price. Okay, so this fixed price is called a strike price. You will be buying at a fixed price of 850. For that you have to pay 20 rupees. This 20 rupees is premium. Okay, so you are buying the Reliance shares at 850. The premium you have to pay is 20 rupees. Okay, now after 6 months, when the contract is expiring, so when the contract is expiring, Reliance share is available at 900. Will you exercise your right? You have the right. Will you exercise your right? Right, you will exercise your right, and when you are exercising your right, you will get the share at what price? At 850. Right, how much will be your benefit? How much is your benefit? Right, so you will, 90 is the price, but you are getting at 850. So this benefit is 50, but please note that you earlier paid 20 rupees for it, so your benefit will be 30. Okay, so you will exercise this at 900. If the stock price is 860, will you exercise your right? If the Reliance share after 6 months the price is 860, will you exercise your right? Please note that the stock price is 860, still I am getting the stock at 850. It still makes sense for me to exercise, and I'm not, okay, I'm losing money, but it doesn't make sense that not to exercise. If I do not exercise, I will lose $20. If I exercise, I will get the share at 850. The current market price is 860. How much money I will make from this transaction? 860 minus 850, 10, but I earlier paid 20 rupees, so my loss will be 10 rupees. But if I did not exercise, I would be losing entire 20, right? You will be asked in the examination whether you will exercise or not. Okay. Now if the share price is 850 at expiration, will you exercise? I'll erase this. Okay. So we had bought a Reliance share. Okay. The denotation is this. Exercise price is denoted as X, or some places it is mentioned as K. Okay. So you have bought a call option. Okay. Strike price is 850. You paid a premium of 20 rupees. Okay. If the stock price at expiration is 850, will you exercise? Here doesn't matter, right? It doesn't matter. So ideally we'll say you will not. It doesn't matter, so you will not exercise. Why you want to take a headache? Okay. If the stock price is 830, will you exercise? No, right? So what we are saying is I will exercise only when stock price is greater than the strike price, right? So I will exercise only when the stock price is greater than the exercise price. And how much benefit I will get? Benefit I will get is irrespective. So I will exercise, I will exercise only when the stock price is irrespective of the difference. Okay. So what you will say is I will exercise this. Okay. And the benefit that I am getting is the payoff I am getting is, so that is what we call as payoff. Okay. That is the money that you will be getting. It is given as maximum of, okay, stock price minus exercise price. Okay. But this is, if the stock price is 830, 830 minus 850 is negative 20. So what we say is when it be that is the case, that's why I want to have maximum of stock minus exercise price or 0, whichever is more, okay, minus the premium paid. Okay, so this is your net payoff after excluding the premium. Okay, so when the stock price was 900, you are getting a benefit of, so maximum of 900 minus 850 comma 0 minus 20. 900 minus 850 is 50 minus 20, you are getting 30. When the stock price is 860, maximum of 860 minus 850 comma 0 minus 20, you are getting minus 10. If the stock price is 830, you will have maximum of 830 minus 850 comma 0 minus 20, it will be minus 20. Why? Because 830 minus 850 is minus 20. So 830 minus 850 minus 0, so minus 20. So that is the premium, that is the net payoff that you are getting. Okay. So this is when you are bought the call option. Okay. But when you sell the call option or when you sold the call option, it will long payoff, it will be the negative of the short.